Hello and welcome. My name is Nitin Shanbhag. I head investment products for Motilal Oswal Private Wealth. And it's very great to have with me today Vishal Gupta, who is managing partner at First Bridge Private Equity. Welcome, Vishal.
Thank you, Nitin.
It's a pleasure having you today.
Thank you so much.
Now, Vishal carries with him over 20 years of experience, almost 23 years of experience, predominantly in the private equity space, which is a very interesting space in India. It's really starting to come of age over the last 2 to 3 years. So at First Bridge, I would like to get some insights from you in terms of your own experience, how your career has really panned out over these last couple of decades, and what kind of capabilities have you guys built at First Bridge?
Yeah, sure. Thanks, Nitin. It's a pleasure to be speaking to you. So, as a way of my background, I'm from Meerut. My grandfather used to be a farmer. So, for me, that has been quite a journey. That moving from Meerut, then coming to Bombay, then going to US to do an MBA from University of Chicago. Then I worked in New York for 3-4 years. But the real flip to my career came when I joined Motilal Oswal Private Equity in 2008, and the mentorship that I got from Vishal Tulsian and Ramdev Agarwal. So the 11 years that I spent here till 2000, almost 11 years, I would say that was the start of my private equity journey. Though when I was at HDFC, before I went to Chicago, I was at HDFC. There also I did some private equity investments, but they were more at an associate level. So companies like Intellinet, Spectramind, couple of housing finance companies. But real journey started when I was at Motilal Oswal. And I would say it has been quite a phenomenal last 15 years in private equity, both from the kind of the passion and the excitement that I feel around that space, and especially the most thing that I feel about private equity is the privilege of having worked with such accomplished entrepreneurs and to be part of their journeys. Like many of them, you just wonder how you can get lucky to be being associated with names like those, and also to have very capable and very driven people as your colleagues. So the people aspect of private equity is something that I have really enjoyed. And then the story part of it, seeing some successes like people coming from very, very humble backgrounds and then making it really big and then remaining humble and graceful. So that aspect has been very interesting. But in terms of the journey, like, so I started with Motilal Oswal as a vice president, then I became a principal, then a partner, and in my last role, I was a member of the investment committee. So I was associated with 3 funds: IBF1, IBF2, IBF3, part of IBF3. Then I joined Uday Kotak Family Office to head private investments. They were looking to set up a family office. They had sold some stake to CPPIB. I think they had some 8-9,000 crores of liquidity. But for some reason that didn't continue. Then I joined a fund called India Resurgence Fund, which is a special situations fund. It's a Bain affiliate in India. So it's a JV between Bain Capital and Piramal Enterprises. Right. It's a $600 million fund. So in that sense, I have worked across strategies. I have worked in growth capital, then bit in family office, and then in a special situation. One thing which I saw common in all these aspects was that in the end, to do a successful investment and do a successful exit, one thing which is predominantly required is to have a strong management team.
Sure.
Then your ability to understand the company. Now, company could be in whichever situation, but the cash flow, understanding the cash flow, its growth prospects, moat around the company, longevity of the growth, all that. So that remains common. Then understanding the industry structure, that remains common. So in that sense, it has been a very, very enriching experience. And now, last 7-8 months back, I started my entrepreneurial journey as well, where we are raising our second fund, which is First Bridge India Growth Fund, where we are raising a 1,000 crore fund. And we already had done our first close. We got some institutional capital.
Sure.
And now we are looking forward to support from Motilal Oswal.
Sure.
So when I was thinking about what kind of a team we should put together
Right.
for First Bridge,
Right.
I think it was very clear that the team needs to be well experienced, because this business requires a lot of like you need to be, if I use the word Hindi, बहुत सारी समझदारी, ईमानदारी और जिम्मेदारी,
बिल्कुल
3 चीज़ें बहुत ज़्यादा ज़रूरी हैं बिजनेस में. So we have put together a team of 10 people now. So KK Rathi जो मेरे co-founder हैं, and in fact KK Rathi was my first boss at Motilal Oswal. private equity, and I met him in 2008. We both were together on a couple of transactions. So he comes with a lot of experience of operations also. So he was a CFO of Pantaloon Group, HR&N Johnson, and KEC International before he started private equity journey.
Right.
Then he was CEO of Future Ventures, which was a listed arm of Future Group to invest in consumer assets.
Right.
So he brings an experience of operating and investing. I have close to 17, 18 years of investing experience. Then we have a team of another 8 professionals who all are from private equity background, at least the senior level. So we have one partner, 2 principal, VP, and all. So pretty much everybody, of course, a couple of associates, they are new to the business.
Right.
So that way we have built a capability set which is very attuned to strong deal sourcing, strong deal evaluation, and then ability to close the transactions, and then monitoring them. Every member of the team, most of the members of the team have seen complete life cycles of their investments. So they have seen investment, monitoring, exits. Similarly, we all have seen multiple life cycle or multiple cycles of the economy, from euphoric time of very depressing times of 2008 to then some good times, then again, then very euphoric times. So we have gone through, and then COVID and all of that. So that all things have, so the playbook that we are bringing into FirstBridge has been honed over the last 15 years across 60 investments. So the team that we have put together, between 3 of us at the senior level, we would have done 60 investments across at different places that we work with. Out of that, 27, 28 investments have been exited. So it's a lot of experience. And then to further enhance our own vision, our own understanding of the industry, and of our and for the promoters,
Right.
we have put together a very strong advisory board. They're like people with the profile of ex-chairman of SEBI and LIC are guiding us on governance issues. People like CEO of Dixon Technologies, or people associated with Mahindra and Mahindra, or KEC, or Capital Foods. So Ajay Gupta, who was founder of Capital Foods, he is an advisor. So that way we have created a skill set and a advisory board which we think is well tuned to our 3 preferred sector, which is financial services, consumer, and manufacturing. So as a team, we are fully geared to deliver a very good second fund.
As you rightly said, Vishal, people matter most in a business
Yeah.
like this, because it's about personal relationships with the promoters of the companies that you're investing into as well. The next stage really is the investment process, right? And various private equity funds have different kind of processes that they allude to. How do you establish that process?
So for us, the way I break the thing, it is first is the investment strategy with which we started this one.
Right.
So we are focusing on deal sizes between say 40 to 100 crores. Focus on financial services, consumer, and manufacturing, and opportunistically it could be business services. So the first fundamental thing is that we have tried to create a knowledge base, and the reason we chose these sectors was that our previous investments were in the similar space. So all the deals that we have done can be categorized either into FMCG and consumer, financial services, or manufacturing, and opportunistic services. So to begin with, we bring about a lot of competitive advantage of having such deep relationship and the ecosystem in the space. So the way we look at the process is that we need to be responsive to the bankers and all of that. So that it is important that any deal that comes to us is given a response in a very timely manner.
Sure.
So the way we follow is we completely follow a team approach. Everybody on the team has a voice on the table. So it's not that it is 1% fund or 2%
Got
fund.
it.
So we will discuss every deal within the team. Once somebody likes it, then 2-3 members of the team will start it. But the evaluation criteria, which is important, that how do we think about the investments, is we break any evaluation into 4 parts. One is to understand the industry structure. Of course, in addition to multiple things that we do, but the focus to understand that is what is the growth probabilities or growth possibilities in this industry.
Sure.
Whether there have been some players who have been able to make money in the industry as have become bigger, because if the industry doesn't align itself to make money or become larger players, then it is very difficult for your portfolio company to become very big.
True.
Then to understand whether a company in the industry, how deep is the competitive intensity, and how are the players placed, and then to understand the entire supply chain and the ecosystem, that how the distribution works for the industry and all of that. Then closely linked to that is the evaluation of the company, where the again it is broken into two parts. One is to understand the financials, where you focus on. So one thing which we have seen, focusing on working capital of the company is a very good way to get an understanding how well the company is placed.
Right.
Then similarly, the return on capital employed, their growth prospects, how is the margin, how is the gross margin. And while EBITDA margin is important, but equally important is to understand whether the company is spending enough in building a sustainable business, whether they're suppose it's a consumer company, whether they're spending enough on advertising, on marketing. Otherwise, you can underinvest, have a higher EBITDA margin, but it may impact your long-term growth.
True.
So that is on the company part. Then the third, which is not, but perhaps the most important, is the management.
Yeah.
There we prefer first generation entrepreneurs. We want to work with promoters who are very passionate, for whom this is like, and very hardworking. And another thing that I have seen over the years, that they should be very humble and graceful. Because what we felt, and this is again based on the investment where we saw success, this thing, that people who are graceful and humble are able to typically build a good team. Because eventually, it's the team, how well an organization you can build will define eventually how big you can become and all of that. And then you obviously, we do complete forensic diligence and other things to check if there are no hidden red flags, integrity of the promoter and all of that. Those are more hygiene things which I think without that no fund will do it. But the understanding is to see really the passion. So like we are looking at a company right now, whenever I meet the promoter of that company, he can talk about all aspects of businesses. So he's aware of how the taxation works, how the what has been the sale last week and all of that. Now, of course, he has a full-blown team and he encourages us to talk to his team members, but he himself is fully aware. So that is the kind of promoters we want to back. And then the last thing is to really be disciplined around the pricing, because even if you just pay too much for the growth, and if the company goes through any challenges in 1-2 years, and across last 15 years, I have always seen, however good the company may be, will always go through 1-2 years of challenging times.
Absolutely.
Especially when they are in this build-out mode. That time, how you conduct yourself with the promoters and entrepreneurs will decide what kind of a fund you are. But having a pricing discipline still allows you to make good money at the time of exit. So this is how we think about. So pretty much around focus on quality, growth, longevity, and pricing.
So to that extent, given the sectors that you mentioned, if you can help us with a few case studies for the benefit of our viewers, I think they'll be able to relate much better to your companies.
We have 4 companies in our deal pipeline. I would like to highlight 2.
Sure.
One company is an NBFC. So they are into secured lending. Company has really, in last 2-3 years, has been growing really well. I have known the company for last, I would say, 12-13 years. This, in my mind, is their version 3. So when we invested for a part of it, it was version 1. Then post demonetization, company went through version 2. And post COVID, the company is in version 3.
Right.
And now it is in a great growth phase. They have raised enough capital, so they are well capitalized. So the reason why we are liking this space is the secured lending, I think, is here to grow. It's a great function of capturing the GDP growth.
Sure.
So this company should be able to grow at least 2 to 2.5x of the GDP growth, a nominal GDP growth rate. So we are getting a great growth story. The management team is very strong. They bring in a blend of deep experience, understanding of the space, and now a controlled aggression. So they are not conservative, yet at the same time they are not going to bet the house to chase the growth. So I like that controlled aggression, the growth.
Right.
Their gross NPAs, their liabilities profile, all is very, very interesting. So I think this company can go public in next couple of years. And we are very, very excited. And the enterprise at which we are looking to enter is also very reasonable.
Sure.
So hopefully next 30-40 days we should be able to close that deal. So very good story to play the India growth story. Liquidity being there, high governance standards, good management team, strong management team, and good business. Another company which is we are looking at is a company in consumer products space. It's a market leader in its category. So even at the size of the fund that we are, it is great to have a company which is in a market leader. So one thing that I forget to mention, we always typically see the market leadership of the company. It could be in a particular geography, it could be in a particular region, or it could be at a national level.
Right.
But it is important to back some market leader. Here we are getting a national market leader. This company has again been very, very attuned to the times. They started initially in offline channel because that time online didn't exist.
Right.
And it was on returnable basis. But they realized that is not the best way to build a business. So promoter built upon the change. Then entire sale was on a sale basis, nothing on returnable basis. And when this online marketplaces became little larger, now we are market leaders in all the online market spaces. And 65% sale is online, 35% is offline. But the company is completely focused on profitability. Year on year, they increase their EBITDA margin. And this year also their EBITDA margin will be like 13-14%, which has increased from 10-11% in last couple of years. And it will keep going up.
Right.
He's focused on gross margin. And now he's also focused on long-term growth. So he's increasing the total addressable market by getting into certain products. So far the products are female oriented. Now they are getting into certain products which are unisex, so which can be used by a large population.
Right.
So these are the two kind of companies that we are looking at. And the reason of excitement in this company is we think the discretionary spend will increase as the GDP grows.
Certainly.
This company is not just growing in that way, it is also using strong brand ambassadors and all to create occasional purchases. So they want that their product should not be one or two with an individual. They should have multiple products for multiple occasions.
Right.
So they are trying to, in that sense, create a market.
Very interesting set of companies.
Yeah, very, very interesting. And then we have two other companies, one in personal care, one in hospital space. Again, both are looking very interesting. So we feel very confident that if we are able to close all these 4 deals, that gives a visibility to around 20-25% of the fund. So we feel very confident that we are off to a very good start.
And last but not the least is the exit, right?
Yeah. So for us, so just to give you this thing, we are fully aligned with our investors. Me and KK Rathi are putting a very large part of our net worth with the funds. So for us, it is equally important that the exits happen in a timely manner and all that. So before we make any investment, we talk to at least 3-4 private equity funds and 3-4 bankers that if a company like this, suppose it becomes 2x or 3x in 3 to 4 years down the line or 5 years down the line, was to come to you, how you would think about that company. Because the way I think about it is, the way I'm thinking about the portfolio construct is 3-4 companies will be late stage, like this NBFC which can go public in next 2 years. So we will have 3-4 companies like those. So those companies typically will go public. But in those companies, we will have limited stake. We will be coming in at a later stage. So that will give stability to the portfolio and an early exit so that we can start returning back capital to our investors early in the process.
Right.
And for the remaining of the portfolio, the way I think about it is around 30 to 40% of those companies, so maybe 4 to 5 companies will be sold to other private equity funds. 2-3 companies like this consumer product company that I mentioned about can be an IPO candidate in 5 to 6 years. So a couple of companies from this portfolio will certainly also go public in this core portfolio.
Right.
And then maybe 2-3 companies will be sold strategically. Like we are looking at one personal care company where it is very clear in 5-7 years, it will not be an IPO candidate. So if we decide to go ahead with that agreement, it will be very clear that after 5 years, strategic sale needs to be undertaken.
Right.
So I think, and so far whatever companies we have in place, we think we should be able to exit. And even if I look at our first fund or track record of previous investments that we did at most of other places, even in our fund one, we have already fully exited 2 companies. In fact, one company got sold to KKR today. So we have seen a strategic exit in our first fund portfolio. And 3 companies or 4 companies are growing very well. So I see that those will be sold either strategic sale or this thing. So typically what we are seeing is if the company is good, where you have gone in, helped build a better institution, a strong management team, and companies in an interesting industry space, exits will happen. But we are very, very conscious about the exit thesis. So we will not invest in any company where the exit thesis is not fully baked, and which we validate through private equity and through talking to bankers. So we can get a full view whether how this company will be viewed in the strategic market, in the IPO market, and whether the investors who are the decision makers for secondary sales, how would they think about the company.
These are very, very useful insights, Vishal. Thank you so much for your time.
Thank you, Nitin, for having me here.